They told you trading was about speed. The faster you clicked the button, the more money you'd make. The faster you caught the move, the closer you'd be to financial freedom. But what if that belief, the very belief millions of traders cling to every single day, is the reason most of them lose? Imagine sitting at your desk, heart racing, screen glowing red and green, convinced that quick reflexes are your salvation. And then imagine learning that the traders who dominate Wall Street, the ones handling billions, aren't the fastest. They're the most patient. That's the paradox Chris Cathey, one of Goldman Sachs' most seasoned traders, revealed through decades of experience. He proved that markets don't reward speed. They reward discipline. They reward restraint. They reward the ability to wait until the market itself hands you the opportunity. Welcome to Trading Psychology Stick, where we break down the hidden playbooks of trading legends. What you're about to hear is educational content, not financial advice. Always do your own research and consult professionals before making investment decisions. Today, we're diving into a framework that transformed how institutional traders think about risk, patience, and opportunity. This isn't about predicting markets. This is about rewiring how you think, how you see risk, how you respond to volatility, and how you transform from a gambler chasing candles into a strategist navigating storms. Chris Cathey's method is not glamorous. It is not a get-rich-quick formula. It is a discipline, sharpened across bull markets, bear markets, crashes, and recoveries. And once you internalize it, you'll never look at trading, or yourself, the same way again. Think of this as entering the captain's cabin of a ship in the middle of a storm. Outside, waves crash violently, winds howl, and most sailors panic. But inside, the captain studies the compass, the sails, the structure of the vessel. He isn't rushing to fight the sea. He's aligning with it. He knows that storms don't just destroy, they also carry you faster than calm waters ever could, if you know how to steer. Cathey's philosophy is exactly that. Learn to see volatility as your ally, risk as your compass, patience as your anchor. In the next chapter, we'll dive straight into the very heart of his strategy, the ability to turn risk into opportunity. This is where his playbook begins, and where most retail traders get it fatally wrong. Are you ready to challenge everything you've been taught about fear, risk, and volatility? Then let's set sail. Chapter 1. Risk as opportunity. Volatility. The very word makes most traders nervous. It conjures images of sudden crashes, of wild spikes that trigger stop losses in seconds, of heartbeats racing as portfolios swing violently up and down. To the untrained, volatility is chaos. To Chris Cathey, volatility is the lifeblood of trading. It is the wind that fills the sails, the very energy that makes the market move. Without volatility, there is nothing to harvest. Without volatility, you are drifting on a still ocean, with no chance to reach your destination. Here lies the first great inversion in Cathey's methodology. While retail traders fear volatility, professionals anticipate it, prepare for it, and harness it. Picture a market where prices barely move, where every candle looks identical, where the VIX sits buried under 15. In such an environment, the opportunities are scarce. A trader can sit for weeks waiting for a setup that might never appear, but when volatility surges, when the waves rise and the sea becomes restless, the seasoned trader sees abundance. Sudden moves create mispricings. Panic selling reveals bargains. Short squeezes expose fragility. And only those willing to step into the storm with discipline can capture the rewards. Chris Cathey understood that volatility equals opportunity because volatility equals movement. Without movement, no trade exists. He witnessed this firsthand during the great market storms, the dot-com crash, the financial crisis, times when retail traders fled in terror. He learned to view each spike in volatility not as a threat, but as the opening of a new door. The trick, however, was not to jump recklessly through it. The trick was to respect risk as both sword and shield. Think of risk not as a monster lurking beneath the waves, but as the very ocean that carries you forward. Every trade is a contract with risk. You place your capital on the line, and the market offers you potential reward in proportion to the danger you are willing to face. Cathey's genius lay in balancing this contract, never underestimating the danger, but never shying away from it either. He would say that if you seek to eliminate risk entirely, you might as well eliminate trading. To him, a trader without risk is like a car without fuel. This is why retail traders often fail. They misinterpret volatility as the enemy. They shrink their sails, refuse to step out of harbor, or worse, they panic the moment the sky darkens. Cathey's approach was different. He prepared his vessel ahead of time. He calculated his stops like an architect planning escape routes. He managed position size as though distributing weight across the ship. Then, when the storm arrived, he was not frightened. He was ready to ride it. Here's something to consider. Volatility is not optional. You cannot trade without it. You can only decide whether you will be crushed by it or carried by it. Cathey's doctrine insists that you choose the latter. Risk is not a wall to avoid. Risk is a door to pass through, a door that opens only for those with the courage and preparation to walk through it. Now, ask yourself, how have you been treating volatility in your own trading? Have you been running from it, tightening your stops until they suffocate your trades, avoiding markets that move too fast? Or can you begin, from this moment forward, to see risk as the compass guiding you toward opportunity? But seeing volatility as opportunity is only the first step. To truly master it, you need something even more powerful, the ability to remain completely detached when the market tests you. Because even the best strategy crumbles when emotions take control. And that brings us to one of Cathey's most legendary moments, a story that reveals the true power of emotional detachment when $400 million hung in the balance. Picture this scene. The market is against you, your P&L flashing deep red, and the weight of hundreds of eyes bearing down on you. For most traders, this is the breaking point, the moment they fold, panic, and destroy their accounts in a frenzy of bad decisions. But for Chris Cathey, it was simply another test. On one infamous day, he and his desk were short nearly $500 million in exposure. By lunchtime, the squeeze had pushed them into a $400 million loss. Around them, silence consumed the Goldman Sachs floor. 200 colleagues could see the numbers bleeding on the screens, the air thick with tension. Yet, Cathey remained composed, eyes not on the P&L, but on the structure of the market itself. This is the essence of emotional detachment. To Cathey, a trader's emotions are like water flooding a ship. Let them in, and they will sink you. Seal them off, and your vessel remains buoyant no matter how violent the storm. The first rule of detachment is the stop loss. It is not a suggestion, not a guideline, but an unbreakable law. Before every trade, the stop is chosen, sized to the risk, and committed to as though it were carved in stone. Once the level is breached, the trade is cut. No hesitation, no debate, no pleading with the market for mercy. This discipline alone eliminates half of the emotional turmoil because there is no decision to make in the heat of battle. The second rule, never set arbitrary profit targets. Cathey warned that when you demand a certain percentage return, you force trades that aren't there. You chase numbers instead of opportunities, and the market punishes you. Instead, the only target worth pursuing is the alignment of opportunity and risk. Profit is the byproduct of discipline, not its purpose. The third rule, add only to winners, never to losers. This is counterintuitive for most traders, whose instinct is to average down, to rescue a trade that's drowning. Cathey compared this to throwing more weight onto a sinking ship. It only drags you under faster. Instead, he taught to build into strength, to expand positions only when the market confirms your thesis. This transforms growth from reckless hope into strategic compounding. The story of that $400 million lunch loss crystallizes all of this. Rather than panic, Cathey and his team reduced exposure by buying Euro stocks futures at what turned out to be the very top. Painful? Yes, but necessary to stay in the game. When the market reversed later in the day, they increased their shorts, pressing the advantage only once the tide had turned in their favor. By the close, what could have been a career-ending disaster had become a lesson in composure, discipline, and resilience. Let me ask you something that might sting. When was the last time you moved a stop loss because you felt the market would turn? That feeling cost you money, didn't it? Every trader has been there. The difference between professionals and amateurs is that professionals learn to ignore that feeling. They execute the plan, period. Here's a fundamental principle. Emotional detachment is not about being cold or robotic. It is about being free. Free from the tyranny of fear that makes you cut winners too early. Free from the grip of greed that makes you hold losers too long. Free from the crowd's panic that turns storms into catastrophes. Detachment gives you the ability to act not as a victim of emotion, but as a strategist aligned with reality. Cathey's doctrine insists that to master trading, you must sever that cord. You must treat P&L as numbers on a screen, nothing more. You must treat losses as tuition, not as trauma, and you must execute your plan as though it were law, not suggestion. Only then can you stand in the storm and remain steady. But detachment without patience is like having perfect vision in complete darkness. You might see clearly, but you'll still strike at shadows. In the next chapter, we'll explore the 4 dimensions of patience that separate professionals from the perpetually losing crowd, the discipline that tells you not just how to act, but when. Patience. It sounds simple, almost boring, like advice your grandmother might give. But in trading, patience is the razor's edge that separates survival from ruin. Chris Cathey dismantled the myth of the hyperactive trader glued to his screen, firing trades every minute like bullets from a machine gun. He revealed the truth. The best traders are hunters, not gamblers. They wait, they stalk. They time their strikes so precisely that by the time they move, the odds are already bent in their favor. Cathey spoke of patience not as a single trait, but as a discipline with 4 dimensions, each one a layer of steel protecting the trader from their own worst instincts. The first is patience for opportunity. Markets do not offer high-probability trades every day. Most of the time, noise overwhelms signal. Retail traders make the fatal mistake of forcing trades, filling their portfolios with boredom entries that exist only because they couldn't sit still. Cathey called these writing checks to the market. Every boredom trade was money tossed into the ocean. The professional sits on their hands until the setup is undeniable, until the wind truly shifts. The second layer is patience and entry timing. Even the sharpest idea, the strongest thesis, can be destroyed by impatience. Cathey understood that fundamentals tell you what to trade, but technicals tell you when. A trader who enters too early bleeds capital, stopped out again and again, even if the thesis is correct. He compared it to planting seeds before spring arrives. They freeze before they can grow. Technical analysis to Cathey was never about generating ideas. It was about identifying the precise moment when conditions aligned, when entry carried maximum reward for minimum risk. Quick question for you. How many trades have you entered this week simply because you felt you had to do something? If the answer is more than 0, you're paying tuition to impatience. Think about that for a moment. Every forced trade is a donation to someone else's account. The third layer is patience in position development. Retail traders expect instant gratification. Buy today, profit tomorrow. But markets rarely bend to such demands. Cathey's time horizon stretched 1 to 6 months, long enough for a thesis to unfold, for catalysts to trigger, for market consensus to shift. He knew trades needed space to breathe. He knew that cutting too soon was like harvesting fruit before it ripened. This patience was not passive. It required discipline, the ability to endure small fluctuations without losing sight of the bigger structure. And then comes the 4th layer, patience in personal development, perhaps the hardest of all. Cathey warned that mastery is not achieved in weeks or months. It takes 2 years, 24 months of repetition, mistakes, adjustments, and reflection to transform from amateur to all-around trader. This timeline shatters the illusion of overnight success. Yet, for those willing to endure it, the reward is not just a skill set, but an identity. A trader who has seen multiple regimes, who has built scars and confidence, who has become immune to the childish impulse of rushing. Here's a truth worth writing down. Patience is not about waiting aimlessly. It is about aligning with time. Markets operate on cycles longer than your impulses. To fight them is to drown. To synchronize with them is to sail. Cathey's framework shows that every stage, opportunity, entry, position, growth, demands a different kind of patience. Fail at any one, and the storm consumes you. Master all 4, and you harness the full power of the sea. Now, turn the mirror inward. How many times have you forced a trade because you couldn't wait for the setup? How often have you entered too early, certain you'd miss out, only to watch the market reward those who waited? How often have you cut a trade that would have been a winner if you had simply held your ground? Patience sets the foundation. Emotional detachment keeps you steady. But without a mathematical framework for managing risk, even the most patient and detached trader will eventually blow up. In the next chapter, we enter the engine room of Cathey's system, the risk management matrix that transforms random bets into calculated opportunities. Chapter 4, the risk management matrix. Risk management. The phrase gets tossed around like a cliché, but for Chris Cathey, it was not a buzzword. It was the skeleton that held every trade upright. Without it, everything collapses. With it, even the most volatile storm becomes navigable. Risk management, in Cathey's world, was not simply about placing a stop-loss and hoping for the best. It was an entire matrix, a system of measurements and adjustments that gave him the ability to survive and profit across every market regime. The first axis of this matrix was quantification. Cathey never asked, "Do I feel comfortable with this trade?" He asked, "What percentage of my portfolio is exposed? What is the dollar risk at stake? How does this position correlate with the others I hold?" He treated each trade like a line item in a ledger, where exposure had to be justified by numbers, not emotions. This meant no single trade, no matter how tempting, could ever sink the ship. The position size was calibrated, adjusted for volatility, beta-weighted, and stress-tested against the rest of the portfolio. If the numbers didn't work, the trade was never taken. The second axis was volatility-adjusted risk. Not all seas are equal. Some are calm, some are raging. Cathey understood that risk is relative to the environment. In a low-volatility market, position sizes could be larger, stops tighter, and holding periods longer. In a high-volatility regime, the opposite was true. Smaller sizes, wider stops, faster exits. This dynamic adjustment was the difference between professionals who adapted and retail traders who traded every day the same way, blind to the tide. Cathey never forgot that opportunity cost is real. Trades age. A position held too long without progress was dead weight. Like milk left out too long, it had to be discarded. He constantly asked, "Is this thesis still valid? Has the catalyst expired? Am I holding on out of logic or out of inertia?" By monitoring the lifespan of trades, he ensured capital flowed only where the probability of return remained alive. And at the core of this matrix was the golden rule: add to winners, cut losers without emotion. This principle sounds simple, yet most traders violate it daily. They let losers expand like cracks in glass, hoping they'll somehow heal, while trimming winners prematurely to lock in gains. Cathey inverted that instinct. He cut losers quickly, sealing the breach before it spread, and reinforced winners, building strength only where the ship was already moving with the current. The stop-loss, of course, was sacred. Predetermined before entry, placed not at random round numbers, but at levels defined by technical and structural logic, stops were executed without hesitation. To move a stop was to break the covenant of discipline, and Cathey never allowed it. Consider this carefully. Risk cannot be eliminated. It can only be shaped, sized, and steered. By building a matrix around it, Cathey turned chaos into structure. Every trade became not a gamble, but a calculated bet, where loss was survivable, gain was scalable, and capital was always preserved for the next opportunity. Now reflect. How do you treat risk? Do you size every trade consistently, blind to volatility and correlation? Do you hold on to trades long after their thesis has expired? Do you let losses expand while cutting winners too soon? If so, your ship is already leaking, and every storm is a death sentence. The risk management matrix gives you the framework, but you still need precision in execution. And that's where most traders get it completely backwards, confusing technical analysis with idea generation. In the next chapter, Cathey reveals why technicals are not for finding trades. They're the scalpel for executing them with surgical precision. Chapter 5, the 1 to 2, steps ahead. Principle. Every trader dreams of being ahead of the market, but Chris Cathey exposed the trap hidden in that dream. Being too far ahead is just as deadly as being too late. The genius lies in timing your anticipation so precisely that you're 1 or 2 steps ahead, never more, never less. That narrow window is where trading transforms from speculation into strategy. Think about it this way. If you're 3 or 4 steps ahead, you're right in theory, but wrong in practice. You spot the coming shift in technology, policy, or economic trend long before the crowd. You stake your claim, and then nothing. The market doesn't move, not yet. Your capital sits idle, bleeding from small stop-outs, eroded by opportunity cost. By the time your thesis finally plays out, you've been shaken out or worn down. You were correct, but correctness doesn't pay bills. Timing does. On the other side, if you're 0 steps ahead, you're chasing. The move has already happened, the catalyst already priced in, the crowd already piled on. You join late, seduced by momentum, and discover that you've bought the very top or sold the very bottom. The market turns against you, and you're left wondering why every trade feels like a cruel joke. Cathey carved out the razor's edge, 1 to 2 steps ahead. It's the sweet spot where catalysts are visible but not yet obvious, where consensus hasn't crowded in, where technicals align to offer optimal entries. Being 1 or 2 steps ahead means you can ride the shift as it becomes undeniable, while others are still doubting. You're early enough to capture the meat of the move, but not so early that you drown in waiting. He taught his mentees to constantly ask, where is the market's gaze right now, and where will it be looking in the next 1 to 6 months? That horizon is the trader's zone. Too much further, and you slip into investing, a game of years and decades, vulnerable to too many variables. Too much closer, and you slip into chasing, a game of crumbs with poor risk versus reward. Consider earnings as an example. An investor might build a thesis on a company's 5-year growth potential, too far ahead. A day trader might buy the stock minutes after earnings are released, too late. But Cathey's framework would position 1 or 2 quarters ahead. When leading indicators hint at earnings strength, sentiment remains skeptical, and the chart offers a low-risk entry. By the time results confirm the story, you're already in, riding the wave others are only beginning to notice. Here's the uncomfortable truth. Being early feels smart but pays nothing. Being late feels safe but costs dearly. Being 1 to 2 steps ahead feels uncomfortable because you're betting before consensus. But that discomfort is the signal you're in, the sweet spot. Now, hold the mirror up. How often have you been 3 steps ahead, holding trades that never materialized until after you quit? How often have you been 0 steps ahead, jumping in just as the crowd was exiting? What would change if you committed to living in the space between, always 1 or 2 steps ahead, no more, no less? Cathey called this discipline trading the invisible horizon. It required patience, courage, and conviction born from your own research. But once mastered, it tilted the odds dramatically in your favor. Yet knowing when to strike is meaningless without knowing where to strike. Technical analysis, when used properly, becomes your precision tool, not for generating ideas but for executing them flawlessly. In the next chapter, we'll see how Cathey transformed charts from fortune-telling devices into surgical instruments. To most retail traders, technical analysis is the holy grail. They treat indicators like crystal balls, hunting for patterns that will whisper the market's next move. Chris Cathey dismantled this illusion. He didn't deny the value of technicals. He simply placed them in their rightful role, not as the creator of ideas, but as the execution layer, the scalpel that makes incisions with precision once the diagnosis is already clear. In Cathey's world, fundamentals and macro analysis generate the trade. Technicals only tell you when and where to enter, how much to risk, and how to manage the position. Think of it as the difference between knowing your destination and choosing the exact moment to start driving. The destination comes first. The route and timing must wait until conditions are optimal. Support and resistance zones formed the backbone of his technical toolkit. He didn't clutter charts with dozens of indicators. Instead, he identified price levels where supply or demand had historically shifted. Volume nodes, moving average confluences, Fibonacci retracements, and psychological round numbers that the crowd couldn't ignore. These levels were not just lines on a chart. They were decision points, battlegrounds where conviction would be tested. Patterns mattered too, but only when they confirmed a thesis. A failed breakout in a weak sector was a signal to press a short. A consolidation in a strong stock before earnings strength was a sign to build a position. Divergences in RSI or volume spikes added nuance, but Cathey never let them dictate the trade. They were servants to the thesis, never the master. He warned against the trap of analysis paralysis, staring at charts until you see shapes that aren't there, forcing a story onto noise. He called this trading ghosts. Retail traders fall into this daily, convincing themselves that a random squiggle is a perfect setup. Cathey stripped away the noise, focusing only on clear structures that aligned with his macro-driven view. The brilliance of using technicals as execution lies in efficiency. You don't waste time scanning thousands of charts aimlessly. You already know what you want to trade because your idea engine has identified the sector, the stock, the catalyst. Technicals then answer the surgical questions. Where is the lowest risk entry? Where should the stop sit, beyond the noise but before disaster? Where is the first profit target that justifies the risk? This integration transforms trading from reactive gambling into a 2-step process. Thesis first, execution second. You don't trade because the chart looks pretty. You trade because the market structure confirms your research. And when the two align, you strike with confidence, knowing both brain and chart point in the same direction. Here's what most traders get backwards. Technical analysis is a timing tool, not a prediction tool. Used correctly, it refines entry and exit. Misused, it becomes a toy that cuts you instead of the market. Now, the mirror turns toward you. How many times have you reversed the order, letting an indicator or candlestick pattern dictate your trades without any macro or fundamental reasoning behind it? How many times have you trusted a head and shoulders or a MACD cross, only to realize you had no story, no catalyst, no conviction to hold when volatility struck? But once you know how to execute individual trades with precision, you face a bigger challenge: how to construct an entire portfolio that can weather any storm. Because a single perfect trade means nothing if the rest of your book is chaos. In the next chapter, Cathey reveals the architecture that transforms random positions into a resilient trading machine. A single trade can make or break a day, but Chris Cathey knew that one trade alone never defines a career. What defines it is the architecture of your entire portfolio, the way your positions fit together like interlocking pieces in a three-dimensional puzzle. Without structure, even the strongest trade becomes a liability. With structure, even average trades contribute to steady growth. Cathey built portfolios like an engineer designed skyscrapers, deliberate, balanced, and stress-tested for extreme conditions. He insisted that the sweet spot lay in holding 8 to 12 positions. Too few, and your risk concentrated dangerously on one or two ideas. Too many, and you spread yourself thin, unable to monitor or manage them effectively. The balance allowed for depth of conviction, without the chaos of overload. He kept his exposure balanced, 4 to 6 longs paired with 4 to 6 shorts. This wasn't about neutralizing exposure into perfect symmetry. It was about ensuring that no single market regime could wipe him out. If growth surged, his longs carried him forward. If the market cracked, his shorts provided protection. The portfolio was not a collection of random trades. It was a living system designed to profit in multiple environments. Position weighting mattered even more. Cathey defined 3 layers: starter positions, core positions, and high conviction plays. Starters were exploratory, 3 to 5% of the portfolio, testing a thesis like sending scouts ahead. Cores carried 8 to 12% weight, ideas with solid backing and clear catalysts. High conviction plays, 15 to 20% each, were rare, reserved only for trades where fundamentals, technicals, and timing aligned so perfectly that risk versus reward skewed dramatically in his favor. This pyramid ensured that capital followed conviction, not impulse. Here's a question that reveals everything about your trading maturity. Do your position sizes reflect your conviction levels, or is everything sized the same out of laziness? If you can't instantly tell me which trades in your portfolio are starters versus high conviction plays, you're already trading blind. Correlation was the hidden danger he always checked. It was easy to think you were diversified: long a semiconductor stock, long a cloud software name, long an internet giant, when in truth, all 3 rose and fell together under the same tech factor. Cathey capped exposure so that no more than 30% of his book leaned on a single sector or theme. He constantly ran mental stress tests. If the dollar spiked, if oil collapsed, if rates surged, how would his book respond? He didn't wait for the market to show him. He anticipated the shocks and adjusted before they came. And then there was the daily review. For Cathey, the portfolio was a mirror reflecting his worldview. If it didn't match his conviction about the economy and markets, it had to change immediately. No clinging to old trades. No, maybe it'll come back. If the portfolio stopped aligning with the map in his head, it was a red flag screaming for action. The key insight here: a portfolio is not a pile of trades. It is a single organism, breathing, adapting, and reflecting your edge. Treat it as such, and you build resilience. Treat it as a scrapbook of random bets, and you guarantee disaster. Now ask yourself, how is your portfolio built today? Is it a reflection of your worldview, or just a patchwork of trades you couldn't resist? Do your position sizes reflect conviction, or are they scattered without hierarchy? Do you actually know how correlated your trades are, or are you unknowingly betting your entire account on one theme dressed up in different tickers? Cathey's architecture shows that success is not about the brilliance of a single trade, but the cohesion of the whole. And once you've built this resilient vessel, the real test emerges: how to navigate when the sea itself becomes violent. Because markets don't just trend, they breathe, panic, and sometimes collapse entirely. In the next chapter, we dive into the framework that turns market chaos from destroyer to opportunity. Chapter 8: The Volatility and Bear Market Playbook. Volatility is the great divider. To the masses, it is terror incarnate. To Chris Cathey, it was the signal flare that opportunity had arrived. He treated volatility like a skilled kayaker treats rapids: dangerous if you fight them, exhilarating if you know how to use their power. He understood that markets don't move in straight lines. They breathe, they expand and contract. And in their most extreme form, they transform into bear markets, the ultimate test of a trader's discipline. When volatility sat low, say the VIX lingering beneath 15, the sea looked calm. Retail traders loved this environment. Prices drifted upward, stops rarely triggered, everything felt safe. But Cathey knew this was precisely when danger lurked. In low volatility regimes, he increased position sizes and extended holding periods, but he also prepared for regime change. Calm seas never last. He would quietly build shopping lists, scanning sectors, preparing to pounce when the inevitable storm arrived. When volatility rose into the mid-range, VIX between 15 and 25, this was his sweet spot. The market moved enough to generate opportunities, but not so violently that positions became unmanageable. Here, he ran his standard playbook: balanced long and short exposure, normal position sizes, active but not frantic management. It was in these conditions that his process felt most natural, each trade a measured step across shifting ground. But when volatility exploded, VIX surging past 25, markets swinging 5% in a day, this was when most traders fled. Cathey did the opposite. He adapted. He reduced gross exposure, shrank position sizes, and widened stops. He traded faster, harvested profits more quickly, and refused to let hope creep into decisions. He treated high volatility markets like whitewater. You don't fight the current. You use its force to move faster than you ever could in calm water. And then there were bear markets, volatility's ultimate expression. Cathey mapped every bear market into 3 distinct phases. The first was denial. Optimism still clung to the air. Investors called every dip a buying opportunity. Headlines reassured the public that fundamentals remained strong. But beneath the surface, leadership stocks cracked, credit spreads widened, and volume spiked on down days. This was when Cathey began positioning, quietly establishing shorts in vulnerable companies, often those bloated with debt or riding unsustainable hype. Then came capitulation. Selling turned forced. Margin calls spread like contagion, and correlations across sectors spiked toward 1. It no longer mattered whether a company was strong or weak. Everything was liquidated to meet cash demands. Retail traders froze or blew up accounts here. Cathey thrived. He reduced position sizes to control risk, widened his stops to handle the violence, and harvested profits quickly. He didn't try to catch every move. He took what the market offered, then stepped aside, always preserving capital for the next strike. Finally came despair. Volume dried up, headlines declared the end of growth, and no one wanted to touch equities. But Cathey knew this was also where seeds of the next bull market quietly took root. While others abandoned the field, he scanned for quality companies oversold beyond reason, building positions for the inevitable rebound. Think about this pattern. In the 2008 financial crisis, while most traders were getting margin called or sitting in cash paralyzed by fear, Cathey and traders like him were methodically building positions in oversold banks and tech companies that would go on to deliver 1,000% returns over the next decade. The difference wasn't luck. It was preparation meeting opportunity. The critical lesson: markets climb the stairs and take the elevator down. Volatility contracts slowly but expands violently. Bear markets don't just test your strategy, they test your identity. They ask if you are truly a trader or merely a passenger of good times. Now hold up the mirror. How do you react when volatility spikes? Do you freeze? Do you panic? Or do you adapt? Can you see bear markets not as disasters, but as the rare windows where fortunes are made? But to consistently find opportunities in any market condition, bull or bear, calm or chaotic, you need something more, a constant flow of fresh ideas. You need an engine that never stops generating possibilities. In the next chapter, we unveil how Cathey kept his pipeline perpetually full with high-conviction trades. Chapter 9. The Idea Generation Engine. If risk management is the skeleton of a trader's craft, idea generation is the beating heart. Without it, the body collapses, lifeless. Chris Cathey understood this better than most. You can be the best risk manager in the world, but if your ideas are weak, if your trades are born from noise, then all you've built is a fortress guarding emptiness. The fortress may not collapse, but it will never grow. To thrive, you need a constant engine that turns raw data into actionable opportunity. And this was Cathey's obsession. His process began at the very top of the economic hierarchy. He studied leading indicators the way a chess grandmaster studies opening positions. Manufacturing surveys, employment reports, consumer confidence data, retail sales. These were not abstract statistics to him. They were signals, whispers of where the storm would form and how strong it would become. He knew that equity markets themselves act as leading indicators for the economy, often 6 months ahead. But he wanted to be one step further still. He wanted to anticipate where the market would anticipate. From these broad signals, he drilled down into sectors. Which industries were poised to accelerate? Which were slowing, vulnerable to cracks in demand, or tightening credit conditions? He looked for rotation. Capital flowing out of one sector and into another. Growth speeding up in one corner of the economy while another began to sputter. To him, this rotation was the wind shifting direction, an invisible force moving the sails of the market. Within each sector, Cathey searched for outliers, the strongest horses to bet long, the weakest to bet short. He dissected fundamentals, seeking acceleration or deceleration in earnings, balance sheet strength or fragility, competitive edges or fatal flaws. By this point, his trade ideas were no longer vague concepts. They were specific, executable, targeted. But Cathey knew that not every idea could be pursued. This is why he enforced the 20-plus ideas rule. For a portfolio of 8 to 12 positions, he demanded at least 20 active ideas on the bench. Why? Because not every idea matures. Some expire before entry. Some are invalidated by new data. Some take too long and tie up capital unnecessarily. By maintaining abundance, he ensured that when one trade was cut, another was ready to sail. And here comes the crucial insight: independence. Cathey insisted that your ideas must be your own, not borrowed from broker research, not lifted from a friend's chat room, not copied from headlines. Why? Because if the idea is not yours, you will never have the conviction to hold it through the inevitable volatility. The moment it turns against you, you will abandon it, because you never truly believed in it. Independence of thought is not just intellectual pride, it is survival. Take a moment to be honest with yourself. Where do your trade ideas really come from? That hot tip from Reddit that went nowhere? The Twitter guru whose track record you've never verified? Or do you have a systematic process, a way of reading the economic weather that leads you to your own conclusions? Without this independence, you're not trading, you're following, and followers rarely lead in profits. This engine is not glamorous. It requires patience, constant research, and the humility to kill your own ideas when the data turns. But it transforms chaos into clarity. It gives you the compass and the map. And this idea engine feeds directly into something equally critical: your watch list, the living organism that ensures you're never caught without ammunition. Because the secret to consistent trading isn't just managing what you have, it's cultivating what's coming next. Chapter 10. The Watchlist Discipline. A portfolio is alive only if its future is alive. Chris Cathey taught that the true secret of professional trading is not just managing the trades you have, but cultivating the trades you don't have yet. The watch list was his hidden weapon, a constantly refreshed bench of opportunities, waiting for their moment. To ignore it was to drift blind. To master it was to ensure the next wave of profit was already forming before the last one had crested. Cathey treated the watch list like a farmer treats his fields: constant cultivation, regular pruning, fresh planting. Every month, he refreshed it with new data: economic releases, sector shifts, earnings reports, credit spreads, policy changes. If the fundamentals shifted, the thesis shifted. If the catalyst expired, the idea was cut. Nothing stale was allowed to remain. He compared this discipline to maintaining inventory in a restaurant. If you don't clear out what's expired, you can't serve anything fresh. He demanded abundance, At least 20 ideas for a portfolio of 8 to 12 positions. Why such a surplus? Because most ideas never make it to execution. Some die on the vine, invalidated before they ripen. Others take too long, capital better used elsewhere. Some prove weaker than expected, once tested against technicals. Without a surplus of ideas, a portfolio stagnates, relying on hope instead of opportunity. With a rich watch list, every stop out becomes an invitation to replace weakness with fresh strength. The watch list also acted as a mirror of conviction. If it wasn't full, it meant the trader wasn't doing the work. If it was cluttered with half-baked concepts, it meant the trader was cutting corners. Cathey drilled this lesson into his mentees. A watch list is not busy work, it is your arsenal. And like any arsenal, it must be stocked, polished, and ready for battle at all times. Here's something most traders never realize. Your watch list is actually more important than your current positions. Why? Because your current positions are the past, decisions already made. Your watch list is the future, where your next profits will come from. If you're not cultivating that future, you're already falling behind. Now, look at yourself. Do you keep a living watch list, refreshed with each cycle of data? Or is your idea pipeline dry, leaving you to chase headlines and tips when your portfolio needs new blood? Do you replace trades with fresh conviction? Or do you let portfolios rot with positions you no longer believe in? Cathey's discipline demanded constant renewal, and this lesson cut deeper than trading alone. It was about mindset. A trader who builds a living watch list builds resilience. A trader who neglects it guarantees decay. But even with all these systems in place, even with perfect discipline, success requires one more element: the ability to translate institutional advantages into retail opportunities. Because while you may not have Goldman Sachs' resources, you have something they don't: flexibility, freedom, and the ability to move like water through markets. In the next chapter, we'll see how to turn apparent disadvantages into your greatest strengths. Chapter 11. The Institutional Edge Translated. Inside Goldman Sachs, Chris Cathey commanded an arsenal few retail traders could imagine. Real-time terminals feeding every piece of news, algorithms slicing orders invisibly through the market, research desks pouring out reports, and the balance sheet of a giant behind him. But what made Cathey dangerous wasn't just access, it was discipline. And discipline, unlike infrastructure, can be borrowed. He believed the institutional edge could be translated into a retail edge, if you knew which parts mattered most. Institutions thrived on 3 pillars: information, capital, and infrastructure. Information meant constant flow, calls with company executives, whispers from peers, economic data dissected before the public even blinked. Capital meant size, positions measured in hundreds of millions, access to leverage at rates no individual could dream of. Infrastructure meant execution, risk models that mapped every exposure, technology that minimized slippage, compliance teams that cleared the path. But retail traders are not doomed. Cathey taught that individuals have their own hidden advantages, often ignored. The first is flexibility. Institutions move like oil tankers. Retail traders move like jet skis. An institution can't dump $1 billion position in a thin market without moving price. You can. You can flip in and out without leaving a footprint. You can switch strategies in hours, where institutions need weeks of approvals. The second is freedom from pressure. On a trading desk, every trader's P&L is visible. Quarterly performance reviews hang over your head. The pressure to perform now drives bad decisions. Retail traders answer only to themselves. Done right, this means patience, waiting for the setup, holding through noise, refusing to trade for the sake of appearances. The third is time horizon. Institutions often face artificial deadlines: month-end, quarter-end, year-end. Investors demand returns, clients demand liquidity. Retail traders can stretch horizons across months, even years, free from redemption pressure. That patience is gold if wielded with discipline. So, how do you bridge the gap? Cathey laid out a translation framework. Adopt institutional processes, strip away institutional constraints. Build watch lists as if you were running a desk. Size positions with the same risk rigor, even if your numbers are smaller. Demand from yourself the same level of record-keeping, review, and accountability. But also leverage your speed, your freedom, your independence. Trade markets and instruments institutions can't touch because they're too small or illiquid. Pivot strategies when regimes shift, while giants lumber behind. Here's what this means practically. You don't need a Bloomberg terminal that costs $24,000 a year. You need discipline that costs nothing but effort. You don't need a team of analysts. You need a systematic process for generating and testing ideas. You don't need millions in capital. You need proper position sizing that protects what you have. The wisdom bomb. Retail traders lose not because they lack Goldman Sachs terminals, but because they fail to adopt Goldman Sachs discipline. The advantage is not in the tools, but in the process. If you build process with rigor, your retail account can operate with the sharpness of an institutional desk, minus the bureaucratic chains. Now ask yourself, do you treat your trading like a business with systems and reviews, or like a hobby with random bets and wishful thinking? Do you hold yourself accountable like a pro, or excuse your lapses like an amateur? The wisdom bomb. Retail traders lose not because they lack Goldman Sachs terminals, but because they fail to adopt Goldman Sachs discipline. The advantage is not in the tools, but in the process. Once you commit to this process, you are no longer just a retail trader. You are a professional in training, operating with an institutional mindset. But this transformation isn't a single event. It's a journey. And now, we arrive at the culmination of everything, the complete roadmap that turns these principles into mastery. Chapter 12. The Complete Trader's Journey. At the end of all the frameworks, rules, and doctrines, Chris Cathey left one undeniable truth. Trading is not a hobby. It is a journey, a transformation of character as much as capital. He often described it as a 2-year minimum apprenticeship, a passage from chaos to clarity, from impulse to discipline. And this journey, if taken seriously, can shape not only how you trade, but how you live. The first year is foundation. In months 1 to 3, the novice trader learns the landscape, economic indicators, sector rotations, the rhythm of earnings, the role of volatility. Paper trading is allowed, but only as rehearsal. Real growth begins with real money, however small. By months 4 to 6, the trader places their first genuine positions, faces their first stop-outs, and learns that losses are not failure, but tuition. Months 7 to 9 expand into managing multiple positions, balancing longs and shorts, building the first real watch list. By months 10 to 12, the trader is managing a portfolio, wrestling with discipline, and confronting emotions head-on. The goal is not profit yet, but survival and process. The second year is refinement. Months 13 to 15 bring recognition of market regimes, learning to shift between low and high volatility, to adapt sizing and stops dynamically. By months 16 to 18, consistency becomes the obsession, cutting boredom trades, resisting noise, documenting performance. Months 19 to 21 transform the trader into a strategist, building track records, mastering conviction without arrogance. Finally, months 22 to 24 mark competence, an independent trader who can generate ideas, execute with precision, manage risk ruthlessly, and remain emotionally detached through storms. Cathey crystallized this path into 10 commandments. Be patient in all dimensions. Be detached from P&L and ego. Guard risk with sacred discipline. Generate your own ideas. Stay 1 to 2 steps ahead. Never more, never less. Use technicals only for timing. Keep your portfolio aligned with your worldview. Add to winners, cut losers without hesitation. Embrace volatility as opportunity. And above all, commit for at least 2 years, because mastery is measured in cycles, not days. The stark reality. Trading is not about being right. It is about surviving when wrong and compounding when right. You don't win by perfection, you win by asymmetry. Small losses, large gains, repeated with discipline until the edge compounds into wealth. Now, pause and ask yourself, are you dabbling or are you on the journey? Are you chasing quick wins, or are you laying bricks for a fortress that will stand storms? Will you quit after a string of losses, or will you accept them as part of the tuition every master has paid? The Cathey method offers no shortcuts. It offers something more valuable, a proven path. From foundation to refinement, from novice to professional, it is a journey anyone can walk, but only those with patience, discipline, and detachment will reach the end. And so, the final question remains, not from Cathey but from yourself. Will you commit because the markets will test you endlessly? But if you follow the path, if you internalize the rules, if you embrace the journey, then one day you will wake up, not as a trader chasing the market, but as a trader who has mastered it. Markets change, technology evolves, but human nature remains constant. Fear and greed still drive the crowd. Discipline and patience still separate winners from losers. The principles Cathey taught are timeless, precisely because they're rooted not in any particular market or era, but in the fundamental truths of human psychology and probability. The future belongs not to those with the fastest computers or the most data, but to those who marry timeless discipline with adaptive thinking. And that journey, that transformation from amateur to professional, begins with a single decision. Will you commit to the process, or will you keep searching for shortcuts that don't exist? You've just walked through Chris Cathey's complete trading philosophy, a playbook forged on Goldman Sachs trading floors, sharpened through crises, and distilled into a framework any serious trader can apply. From volatility as opportunity, to emotional detachment in the face of $400 million losses, to the 4 dimensions of patience, to risk management as a living matrix, the message is clear. Trading mastery isn't about luck or speed. It's about discipline, renewal, and commitment over time. Let's recap the journey you've taken here. You learned that risk is not the enemy, but the engine. You discovered how emotional detachment kept Cathey steady when others panicked. You explored his 4-layered patience framework, his risk management matrix, and his principle of staying 1 to 2 steps ahead. You saw how technicals serve as execution tools, not idea generators. You understood portfolio architecture, the volatility bear market continuum, and how to build an idea generation engine that never stops. You learned the importance of a living watch list, how to translate institutional advantages to retail trading, and finally, you traced the complete 2-year journey from chaos to competence. But here's the truth. None of this matters unless you act. Knowledge without commitment is entertainment. The markets don't pay for entertainment. They pay for execution. So here's my challenge to you, and it matters more than you might think. Comment below with one specific principle from this video that you're committing to implement starting today. Not tomorrow, not next week, today. Will it be cutting boredom trades that drain your account? Will it be building that 20-idea watch list you've been avoiding? Will it be finally accepting volatility as opportunity instead of running from it every time the VIX spikes? Will it be setting stops before entry and never moving them, no matter what your emotions scream? Whatever it is, declare it publicly. Because when you write it down where others can see it, you create accountability that goes beyond just yourself. You make a promise not just to your future profits, but to this community of traders walking the same path. And here's what's powerful about that. When you see others committing to the same principles, you realize you're not alone in this journey. The path to mastery is challenging, but it's less daunting when you're walking it alongside others who refuse to accept mediocrity. This channel, Trading Psychology Stick, isn't just about consuming content. It's about transformation. If you found value in this deep dive, subscribe so you don't miss the next breakdown of the world's greatest trading minds. And if you're serious about your journey, here's what I suggest. Rewatch the sections that hit hardest. Maybe it was the emotional detachment doctrine and that $400 million story. Maybe it was the bear market playbook. Maybe it was the realization that you've been using technicals completely backwards. Whatever resonated most, go back and absorb it deeper. Write down Cathey's 10 commandments and keep them beside your screen. Let them guide you every time temptation whispers to gamble instead of trade. Because the difference between gambling and trading is not the outcome. It's the process. Gamblers hope, traders execute. Gamblers blame luck. Traders own their decisions. Gamblers seek excitement. Traders seek edge. Remember this one-liner that Cathey lived by. Trading is not about being right. It's about making more when you're right and losing small when you're wrong. If you can internalize that single principle, if you can live it in every trade you take, you've already separated yourself from 90% of market participants. The markets will test you tomorrow, and the day after, and the day after that. They will tempt you with FOMO when everyone else is buying. They will terrify you with panic when everyone else is selling. They will bore you into forcing trades when nothing is happening. They will seduce you into moving stops when losses mount. Every single day, the market will offer you a choice. Follow the crowd or follow the discipline. His legacy lives not in any single trade, but in the framework he left behind. It is both brutally simple and endlessly difficult, because it demands mastery not just of markets, but of self. The market will never stop testing you. It will tempt you with noise, scare you with volatility, seduce you with hope, and punish you for arrogance. But if you carry Cathey's principles, you carry a compass that never loses true north. The final question isn't whether Cathey's method works. It has been proven in bull markets, bear markets, and crises alike. The real question is, will you walk the path? Will you commit to the 2-year journey? Will you embrace the discipline even when it's uncomfortable? Will you cut losers even when hope whispers to hold? Will you stay patient even when everyone else is rushing? The choice, as always, is yours. But remember this: every professional trader you admire, every fund manager who consistently beats the market, every legendary name in trading history, they all walked this same path. They all paid the same tuition. They all faced the same demons. The only difference between them and everyone else is that they didn't quit. They committed to the process, trusted the discipline, and let time compound their edge into mastery. So, I'll leave you with this final thought. In 2 years, you'll be 2 years older regardless. The question is whether you'll also be a master trader, or whether you'll still be searching for the secret, not realizing you had it all along. The secret is that there is no secret. There is only discipline, patience, and the courage to commit to a process that works. The path is clear, the principles are proven, the only variable is you. Will you walk the path,